I'm diving into one of Canada's most popular dividend ETFs that pays you monthly, Vanguard's VDY. I'm diving deep. What's in it, how it behaves, what to love and what to watch out for, including the risks no one talks about. By the end of this video, you'll know all you need to know if VDY is the income ETF for you. Let's do this! I'm Mr. Financial, and I help DIY investors like you understand ETFs and investing principles so you can invest with confidence, not based on internet hype. If that's your vibe, hit that subscribe button so you don't miss an upload. Let's get into it with a high-level overview. What exactly is VDY? It is Vanguard's FTSE Canadian High Dividend Yield Index ETF. This ETF focuses on the obvious Canadian companies that are characterized by high dividend yield. It currently holds 56 stocks with an earnings growth rate of 6.6%, and it has a monthly distribution with a yield of 3.6%. I know income folks will love that point. And it is considered medium risk. It was launched in November of 2012. It trades in CAD. It has $6.6 billion in total assets, so it's a pretty good size. This is the most popular high-yield income ETF in Canada. You can find all this information on the main page of VDY. There, you have quick access to other essential literature, such as the prospectus, ETF facts, the annual report, and financial statements. You should review these documents before making a decision on any ETF you plan to buy. Now let's get a good look under the hood. This is a low-level deep dive on how this ETF, VDY, is constructed, especially focusing on what index VDY tracks and its risk profile. What does VDY track? VDY tracks the FTSE Canadian High Dividend Yield Index. Let me quote straight from FTSE Russell. It says this: it comprises stocks that are characterized by higher than average dividend yields. The index universe is based on the large, mid, and small cap constituents of the Canada country component of the FTSE Global Equity Index series. The ground rules for FTSE GIS also form the basis for the management of the FTSE Canada High Dividend Yield Index. FTSE Russell takes a starting universe of large, mid, and small cap stocks within the Canada component of the FTSE GEIS and ranks these stocks based on their annual forecasted dividend yields. Stocks are then selected based on yield until their combined market capitalization accounts for 50% of the total market cap of the universe of stocks. These stocks are then market cap weighted to form the ending index. The FTSE Canada High Dividend Yield Index will be reviewed annually. The annual review will be implemented in line with the FTSE GEIS North America Regional Review and rebalanced quarterly, March, June, September, and December. So that was a quote. One more thing to note, though. There are some companies that are excluded from VDY, such as REITs and related real estate companies. So that's the basics of the index. From here on in, I'll refer to the benchmark and VDY synonymously, since VDY tracks the index so perfectly with only a little tracking error here and there. Let's look at the 56 holdings of VDY. It uses a full replicated index strategy, also known as a full physical replication ETF, as opposed to a synthetic one that doesn't actually hold the stocks. The top 10 holdings of VDY are exactly the same as the index and make up 68.1% of the fund, nearly double that of the FTSE Canada All Cap Index. The heaviest weighted stock is Royal Bank. It is over double its weight in the FTSE Canada All Cap Index at 14.7%. If you look at just the 5 banks in the top 10, they make up 43.2% of this fund. Do you think that's a little concentrated in the big banks? And look here, the bottom 10 stocks don't even total 1% combined. If you were to calculate the effective number of stocks, you'd see this is actually a lot less diversified than the 56 stocks suggest. Now take a look at the sector weighting of VDY, or the FTSE Canadian High Dividend Yield Index. Financials make up 55.4% of the index. Next comes energy at 27.1%. The next largest sector is utilities at just 5.5%. Sectors like tech and industrials are almost non-existent in VDY, with barely 0.5% between the two. Compared to the FTSE Canada All Cap Index, tech makes up 7.5%, and industrials 7.7%. It's interesting to see that VDY contains no healthcare at all, though it is a tiny sector in Canada anyway. If we dig further and look at VDY's index supersector breakdown, we really get to see where this ETF leans. There are huge differences in the number of constituents for many supersectors, and the difference between the FTSE Canada All Cap Index and VDY is huge. For example, basic resources is negative 18.2%, and industrial goods and services negative 6.3%, and tech negative 7.2%. On the other hand, banks are positive 24.7%, and energy 11%. The surprising thing is financial services, which is negative 3.7%. So this fund really leans into banks, as we already knew. Quick thing, guys, before we continue, if you're finding value in this video, please smash the like button. That's your way of saying, this is the type of content you want me to be making and that you find the most helpful. That's my goal here, to help out fellow DIY investors. Now back to the video. With that out of the way, let's look at the fund style of VDY. It is technically a blended large cap fund, with 48% of the fund in large cap blended and close behind 39% in large cap value, with only 1% large cap growth. It has about 11% exposure to mid caps mainly in value and 2% in small caps only in value. This is to be expected given the screening process for the FTSE Canadian High Dividend Yield Index being based on yield. For perspective, the average market cap of VDY is $126.8 billion. Do you notice anything about the market cap of the fund without looking at the style? This is clearly a large cap fund with a screen for high dividend paying companies. That's how the index was designed. Now, let's get into the most exciting part of VDY, its performance compared to its benchmark. Using the most recent monthly data from Vanguard, since inception, VDY has returned 12%. It has done very well the last 10 years too at 14.5%. The last 5, 18.9%. The last 3, 21.2%. Now check out that 1-year number, 40.1%. That's just crazy. It's obvious that when financials and energy are running red hot, VDY will burn just as hot. Now let's look at annual performance for a second. This will add some color to those 10, 5, 3, and 1-year returns. Do you see how well VDY did during COVID and the 2022 bear market? Its worst year was in 2015 at negative 10.5%, not too shabby. Its best calendar year was in 2021 at 36.6%, nothing to sneeze at. Not to negate those amazing returns since inception, they have been nothing close to smooth. Zooming into the monthly performance, you'll see months where VDY was down 4, 5, 6, 9%, or even 16%, and others that were up just as the same as they were down. And if we look at the best and worst 3-month returns in its fact sheet, we see the worst was in Q1 of 2020, at negative 19.1%. And the best was the next year, ending January 2021 at 17.9%. This further highlights the bumpiness of VDY. If we look at VDY's total returns compared to the benchmark, do you see how it mirrors it almost perfectly? There is a small tracking error of 0.08%. However, that lag is mainly what the management expense ratio will eat away. For VDY, the ETF expenses for 2024 is 0.22%, which is the latest official document we have. This is something you'll want to pay close attention to. Now let's talk about the elephant in the room. VDY is a dividend ETF. It's known for its passive income for Canadian investors and even retirees. It pays monthly distributions and currently yields 3.6%. Here's what the annual distributions have looked like over the years. Most of the distributions come from eligible dividends, which are tax efficient at low income levels in most provinces in Canada. That's one reason it is a Canadian retiree fan favorite. Also, there are rare cases of a return of capital and some years with a lot of capital gains. That's a good problem to have, though none of us like paying taxes on our investments as they compound. So we established that this high dividend income producing ETF leans heavily into banks and energy stocks. Let's now see where most of this performance is coming from by looking at the Morningstar factor profile. As we should expect, it is high yield and high value. It is also currently high momentum, though over the past 5 years, you'll notice it has varied from low to high. VDY is also rock bottom on quality, liquidity, and volatility. The volatility part is great, and it may be why its risk profile is the way it is. With that in mind, let's move to the risk profile of VDY. So I mentioned Vanguard has this fund labeled as a medium risk fund. That means its standard deviation, its SD, can be anywhere from 11 to less than 16. Focusing on the long-term index performance, its standard deviation was 12.3 over 5 years, and it has had a major drawdown of 39.2%, worse than the FTSE Canada All-Cap Index. So even though this monthly pair has a decent standard deviation, it still has had a major drawdown during COVID. Please do not ignore that fact. Let's see what Morningstar's portfolio risk score shows for VDY. It gives us some risk KPIs, but they're not the end-all be-all for analysis. Morningstar rates this as a very aggressive fund at 89. VDY has above average risk and a high return compared to its category over the last 10 years. This next piece is very interesting. VDY has an SD of 13.4 over 10 years and a Sharpe ratio of 0.94. Very good. And lastly, let's look at the price to earnings or PE ratio of the index to get an idea of its value. It is currently sitting at 15.3 for the TTM, trailing 12 months. In comparison to the FTSE Canada All Cap Index at 20, VDY is looking very cheap. However, do not be misled by this. Remember, this holds mainly banks and energy stocks, so a PE of 15.3 is not cheap in that context. To recap, VDY tracks the FTSE Canadian High Dividend Yield Index with a yield of 3.6%. It has an MER of 0.22%, it pays monthly distributions of mainly eligible dividends, and is considered medium risk with high concentration in banks and energy stocks. Before I give my personal take, I wanted to highlight the risks again. VDY is concentrated in 56 high-yielding stocks in only the Canadian market. It targets large-cap stocks with nearly 70% of the fund in 10 names. VDY has had major drawdowns and is much more volatile than the standard deviation would lead one to believe, as we've looked at. It isn't uncommon for a 4 or 5% pullback in a single month, as we saw. It also has relatively high distributions of eligible dividends. That may be a tax issue for high-income earners in a taxable account. Here's my personal opinion on who this monthly pair may be good for. I think VDY is appropriate for long-term investors. That's what I think about most diversified ETFs. It's good for passive investors who are targeting a high yield on the TSX specifically. VDY is good as a satellite position to accompany other core holdings. And VDY is appropriate for investors who can withstand the volatility that comes with high concentration in Canadian banks and energy. And I think VDY is not suited for you if you do not want high exposure to high dividend yield stocks on the TSX. If you are a broad index investor looking for diversification, if you are somewhat conservative in your investments, not comfortable with the higher volatility of VDY, also, if you are looking for short-term trends or returns, VDY is not for you. if you are very weary of high concentration in the Canadian Big Six banks. And if you're in the accumulation phase in a taxable account, VDY is probably not best for you. So that's my full breakdown of VDY, the all-star of monthly high dividend pairs in Canada. You're likely wanting to diversify your portfolio with other ETFs. Check out my ETF deep dive playlist for videos just like this one. See you there.